All right. What are notes receivable? So these are more short term. It's kind of like an IOU. It's not like so you might say like trade receivables. That word that has more to do with during your operations, your trade. So, but notes receivable, this might just be short term borrowings for whatever purpose. It's not necessarily because of our operations, because customers aren't paying us cash right away. So short term notes receivable, long term notes receivable. As short term, we record at face value, less allowance for doubtful. Long-term notes receivable record at present value of cash expected to be collected. Kind of like more like a bond treatment, kind of more like an AR treatment. That's all this is saying. All right, recognizing notes receivable. So as I say here, this is the flip side of bonds. So in bonds, we are going to be the one borrowing money. Like this is the flip side of bonds. So like the person issuing the bonds, while the other party has the receivable, right? This is both sides of the coin, both parties when they are doing business with each other. So if you haven't seen bonds yet, no worries. This is kind of touching into bonds. So revisit this after you've seen bonds. But in this case, we're going to assume a 10% stated coupon rate. That is the actual percentage on the bond, meaning you are actually paying out 10%. It's a stated rate. Discounts and premiums, these are going to be, well, overall, if let's say the market, so as an investor, like I could go online and look up what's the market rate for a corporate bond. And maybe I see that corporate rate is 8%. So I could take $1,000 and make 8% on it. But this company is providing it at 10%. So if I want to give my money to this company, they are actually giving me a premium. So the market rate is, or the effective rate is 8%. The stated or the coupon rate is 10% because the company in this case is giving more. So that bond was issued at a premium. Why is that important? Well, because as an investor, I might give the company more cash up front to get a better interest rate. And similarly, let's say the company is being an El Cheapo and they are giving 10% while the rest of the market is offering bonds at 12%. That bond's at a discount. And if I give them money, I'll probably give them less cash than I would give another company at the market rate. If that was a super brief executive summary, just because we're not really in the bond section, feel free to visit bonds. That is going to be much more in depth there. All right, so notes receivable, we've got non-interest bearing and interest bearing. So maybe you lend your friend's company some money and say, don't worry about interest. Or maybe you say, hey, you owe me interest. That's what this is saying. Because you could also have non-interest bearing bonds, right? You could have bonds that don't pay interest. And those are essentially like, they don't pay interest, but you'll owe more money in the future, like on that lump sum payment at the end. Different reasons for it, right? Just different reasons for what we do. We don't have to worry about why a company would do that. Just know that exists and that's a thing. So for non-interest bearing, we determine the issue price on notes receivable at implicit rate of interest. The discount or premium is amortized to interest revenue by the effective interest method. Again, we'll see this more in bonds. But essentially, this is saying like we got to account for it somehow, even though there's not interest paid. And this is going to have to be at a discount or premium because we are dealing with a bond that, well, why would you buy a bond if it's not going to pay you interest? Well, hopefully it's going to because it's at a premium. Interest-bearing bonds, this is more standard. Determine issue price on notes receivable at the effective rate of interest. The discounted premium is amortized to interest revenue by the effective interest method. So pretty similar between the two. We will see that again more in bonds. But the point here, why I brought these slides into your attention, was just to make the connection, show that this is the flip side of bonds, and it's all connected, right? There's a lot of items and sections in this exam that are very much connected.